Welcome to Nasdaq Trade Talks. I'm Jill Malandrino, Global Markets Reporter at Nasdaq. Joining us is Brian Joyce, Managing Director on Nasdaq's Market Intelligence Desk, for an update on technical levels to watch in the Nasdaq-100 as the index continues to outperform. Brian, before we get into that, honestly, I've been in studio for the past couple of hours, and there has been a reversal in fortune in the market. Dow turns negative. It looks as if the banks are being impacted. I've heard that Yellen's going to come on and speak at 3 o'clock, which is right now. What's happened this afternoon's session?
Well, Yellen was speaking yesterday as well, and it was at the same time that Powell was speaking following the FOMC meeting. We had an initial, constructive reaction in U.S. equities following the 2 p.m. Statement released by the FOMC, where they, it was a dovish hike, as everyone's describing it, rate hike of 25 basis points, but the committee is now assessing whether or not there will be any future rate hikes. The difference with the market and what the guidance, the big difference was with the committee's guidance was they see rates year-end around 5.1%, whereas the market is much lower than that, given what's been happening in the last 2 weeks with banks. And then as Powell's testimony was going on yesterday, Yellen came out and in her testimony and in Q&A made a comment about how her team at the moment is not discussing a blanket deposit insurance policy throughout the country, whereas previously I think there was hope and some committee members or some people in the administration had alluded to that it's something that they're looking at. So that was the catalyst yesterday for the reversal lower.
Yeah, well, and as we're sitting here, it just reversed back into green. So there must be some sort of commentary that's coming out as we're speaking, but a credit is starting to be a concern or more concerning.
Yeah, well, and that's been, kind of a theme that we've been hearing from the sell side, from the analysts. When is that this cycle's credit cycle going to, hit? We didn't have a credit cycle during the decline in 2020 from COVID. We kind of just, had a 30-something% sell-off, depending on which index you're looking at, and then we rebounded within, a matter of weeks, given all the stimulus. So, credit numbers stayed, very constructive throughout that entire brief cycle. And now, given the, long-term rate rise here that we've been seeing, 17 hikes last year, we've had hikes this year, including yesterday. There's a lag effect there. So when is the impact of those rate hikes going to hit the economy? That's the credit cycle that the street is looking for. And was that pull forward, given everything that's happened in the last 2 weeks in the banking industry? And so when you look at the yield curve, that seems to be signs that the street is expecting that economic downturn is being pulled forward quicker. And so, the rate market is adjusting to it, and equities we're fading. We have had a nice run here, and, look at some of the benchmarks, they are, testing some prior highs. So this is, maybe a short-term, level where you would expect to see some resistance and some consolidation. So it's too early to say, what's going to be happening here going forward in the near term, in my opinion.
Okay. Well, the one thing that is definite is what the stock levels are. Let's take a look at the Nasdaq-100 for some fresh technical levels to watch. Clearly outperforming for March, doing better because interest rate narrative is getting a little bit softer than it has been as people look for other areas to put their money.
Yeah, so really since the second week in January, we've seen those growth groups, those growth sectors, technology, communications, discretionary, they've been outperforming after last year being the underperformers. Last week when we spoke, we were talking about, the expectation given the breakout above this declining price channel right here, which was last Thursday, Friday, that our near-term expectation was that it would be able to test those Feb highs at 12,880. We did that yesterday, reversed lower in the latter hour or so of the trading session. We retested it again today, and as you noted, we reversed lower again. But zoom out a little bit, we're consolidating sideways here, right along the prior high, off of the lows going back to October. So, in a level we would expect some short-term consolidation. It's still very early to say, wow, we're going to, reverse to the downside from here. You look at the weekly period chart, we can see that this week's candlestick is still a green candlestick. We're up about 1% on the week. So, that's, not terrible. And that's after, a big, 5 to 6% gain last week. So we are still up this year, I should say this week, following last week's, strong reversal to the upside. So, as concerning as late yesterday was and the reversal lower today, it's still, very kind of short term. This here is a ratio, though. One thing I would highlight is that, the biggest movements we have seen really since the beginning of the year have been in those mega cap stocks. And so this is a ratio of the Nasdaq-100 over the Nasdaq equal weight index. So it just kind of points to you that the Nasdaq-100 is outperforming the equal weight. And I think I have it here on the inverse, so let me just flip it back. There we go. So as this moves higher, what this is suggesting is the Nasdaq-100 is outperforming the equal weight index. And so it doesn't mean the equal weight stocks are not performing in positive territory, but they're just not performing as well. So that's something definitely to keep an eye on as far as one breadth metric grows. Jill, as you were talking to me yesterday when we were discussing on today's show, you mentioned the volatility index for the Nasdaq-100. We could see yesterday's, let me zoom in a little bit, yesterday's low was testing the lows that we've seen really for the last 12 months now. And so the lower the volatility, the more constructive the environment. So again, even with the last kind of a day or so of reversal to the downside off of the prior highs made in February, in the index, in the Nasdaq-100, the volatility hasn't really gotten too high. Nothing to what I would say to be overly concerned about.
Yeah, and I'm looking at VolQ right now. I mean, you could see it upticking and see the Nasdaq-100 coming in a bit here. But what was interesting with the leadership that we saw with the Nasdaq-100, it wasn't your typical FANG stocks or whatever acronym you want to assign to it. It really was more broad-based, right? Because you saw some of the semiconductors coming in, other areas of the market that were coming in, with the Nasdaq-100. So it wasn't like it was predicated on those top 1, 2, 3, 4, 5 names that have such heavy weighting. It was a little bit more dispersed.
A little bit. I think the outperformance has been in the top of the index, but I think if you look at the top 4 or 5, maybe there's 2 that really stand out, and maybe 2 that don't stand out. So. But when we compare to the equal weight index, it has been outperforming. The cap weighted index has been outperforming since the second week of January. So
outside of what's happening in the markets today, as you look out another week or two, anything that you're focusing on, or is it still going to be on the macro? I mean, it's quiet with earnings right now.
Well, we're into late March right now. We don't have another FOMC meeting until early May, so we'll be looking at economic data, inflation data, jobs data coming into early April, and then probably the week after that, we'll be looking for Q1 earnings. And also really be focused on what's going on with banks and interest rates. So we were talking last week about the 2-year yield. I think the 2-year yield is critical. We want to see how this holds up.
Pull up a chart on either the 2-year or the 10-year. The velocity of the moves in the Treasury market it's pretty aggressive. It's not typically what you would see.
Yeah, it's been staggering. The Fed funds rate curve at one point at the lows of last week, the November contract was down almost 200 basis points in 3 or 4 days. So just a strong reversal there. This here is the 2-year Treasury yield. I think this is pretty key to watch. We've seen it pulled back from its highs back on March 8th, which was the Wednesday before this banking quote-unquote crisis began to take effect. And it really blew through that 4% support, which is where the low was back in October, and 405 in early January and early February. And really what it's holding on to right now is this 200-day moving average. We're dipping below it today. If we close right here, this is going to be the lowest close for the 2-year yield. And given the dramatic move that this yield has made, off of late 2021, almost from the zero bound, from a technical perspective, you would think that would be concerning. And then if we look also at the regional bank index, we can see today it retested the lows basically almost to the penny. The intraday lows, which were made last Monday, we just retested those today. So this could be a potential support level to look to when we look at a monthly basis
and that's
chart.
Because people are putting their money into Treasury, shorter term paper, because you're just getting so much better of return. Is that part of it?
Well, I think that's part of it. The expectation, I think, would be that the Fed rate hike cycle is almost complete, if not already complete. And then if eventually the late 23 credit cycle does hit equities, does slow down corporate earnings, valuations may come under more pressure. Although maybe we've seen the worst in valuations as far as PE goes, but maybe those actual corporate earnings could maybe take a hit if we do see the onset of the credit cycle. And the question is, how severe is that going to be? That's the question, soft landing versus hard landing. So if you thought that it was going to be more of a hard landing, then you probably would be more comfortable being long a short-term 2-year Treasury bond that's yielding 4 to 5%.
All right. Appreciate the insight. As always, thanks for joining us on Trade Talks, Brian. And thanks for joining me. I'm Jill Malandrino, Global Markets Reporter at Nasdaq.